You're listening to the Real Estate Runway podcast, powered by Quattro Capital, where we are all about alternative business and investment strategies to help you amplify life and maximize wealth. Here's your host, the recovering engineer turned multifamily investor, Chad Sutton.
I'm excited to welcome Evan Holladay with Holladay Ventures to the show. Evan is a developer of tax credit multifamily properties in the Southeast, and I'm really excited for you to hear the strategy with which he deploys the idea of impact and income at the same time. Without further ado, let's get into it. All right. Welcome to another episode of the Real Estate Runway podcast. I'm your host, Chad Sutton. Welcome back to the show. Here with me today is a great friend of ours, Evan Holladay with Holladay Ventures. Evan is a real estate developer and investor with over 225 million and 1,347 units of multifamily real estate developed and invested. Evan is the founder and CEO at Holladay Ventures, where their team specializes in creating and investing in workforce, affordable, and mixed income communities. Their mission is to create quality housing opportunities and empower residents to realize their full potential. In addition to that, Evan is also the host of the iTunes Top 200 Business and Real Estate podcast, Monumental, where he sits down with top leaders and entrepreneurs making massive change in the world. Super excited for this interview today. Evan, welcome to the show, buddy.
Chad, thank you for having me, man. Glad to be here.
Man, it feels like the last time I saw you was pre-COVID, back when we were still doing live meetups. We were trading those around a lot. So, Evan, that was a fantastic bio we just went through. Tell us a little bit about yourself, because you are such an amazing individual. You have the biggest heart. Impact and investing is really your thing. How did you get to the point to where you started developing multifamily properties? What's the background there?
Yeah, so I think like with any story, it starts with kind of a turning point. For me, that turning point was in college. I was going down this route of not really knowing what I wanted to do. And I ended up finding real estate, just kind of happenstance. I saw a big development going in on campus. I was like, man, I got to be a part of that. I don't know what it is, but it's pulling me in. It's attracting me. Really, for me, it was that turning point. I was like, you know what, that development looks amazing. Like something about that, the idea, the vision, the energy behind it all. That's what really attracted me to it. And so, I was naive and I was like, you know what, I'm going to reach out to this developer and I'm going to figure out a way to work for him or add value to him. And one thing led to another, found a mutual connection, got introduced, and the developer's like, you know what, I'm not just going to hire you. Like, you got to impress me. So we ended up bringing a few hundred people out to his groundbreaking. And after that, I was the first one he hired and really got to learn. That was such an eye-opening experience for me, because working for somebody who does it, you can literally just take quantum leaps forward in your progress of understanding what is actually going on, and how it's actually done. How the cooks actually cook in the kitchen.
Yeah, how the sausage is made, right?
How the sausage is made, exactly. That was the best experience. I was like 19 years old at the time. And I got to work, I wasn't working directly with the developer, but a lot of decisions he made, he consulted with me to get kind of a student's opinion. And that was really, really unique experience. So that kind of opened my eyes to it. And I was on the property management side. I was like, all right, this is a great experience, but I don't want to be doing property management. I want to do what he's doing. That seems like a lot more fun and a lot more exciting to me. And so that just kind of led me down a rabbit hole, and one thing led to another. And next thing I know, in an entrepreneurship class, and we're starting a modular development company. And so there was 5 of us, and we set out to figure out how to make modular housing out of basically houseboat manufacturing plants in Kentucky. Wow. And so we were trying to put people back to work while also creating safe and decent, affordable housing. And we figured out about these designs that students were already making. So we got the rights to the plans. And then we figured out, we're like, hey, well, let's not just build high-end luxury housing like everybody else, like every other developer. Let's actually try to do some good out of this. We can make money for ourselves, we can make money for our investors, and we can do good for the residents and the communities. And that led down another rabbit hole. I was like, oh my gosh, there's this whole world of affordable housing and public-private partnerships and, all this all this world around affordable housing. And that's what got me excited. I was like, whoa, I can have real positive impact in what I'm doing, and I can be in real estate development, like combining two passions of mine. And I think I'd always wanted to help people. I think I got that from my parents. They really taught me to love and take care of others around me. And so combining that with my love of real estate and my love of just building things, I think, I found my sweet spot. So I was fortunate. I found that at a young age, and I just dove head in, and you don't know what you don't know. I was very naive, but I just kept taking action. And one thing led to another. I worked for the number one affordable developer in the country for 6 years, learned a whole lot there, gained a massive, amazing experience working for the best in the country, and then broke off and said, you know what, I think I can do this better. I can do this my way. And I have a clear vision for that. And so, just building momentum around that now. And we've been able to work on some really incredible projects, really around empowering our residents, not just building the affordable housing, but actually giving our residents the tools as far as financial literacy, health and wellness, mindset, confidence, really trying to be proactive and intentional about that. And that's been a really exciting part of building Holladay Ventures. And also, utilizing Monumental, like you mentioned, utilizing Monumental as a tool to, learn myself, help others in our audience learn, and be able to connect and grow a network all over the country that are all impact-driven leaders. So it's, it didn't all happen at once, and it's kind of naively taking one step after the other. But, if you turn around and look back, you're like, wow, all those steps actually added up to something. So that's where we are now.
Man, Evan, you said so many things there that there's just so much to unpack. That is fantastic. So first and foremost, I love what you were talking about with impact over or impact and income, right? There are so many ways to make money, and there are so many ways to do good, right? But why not find a way to do good while doing well?
Exactly.
And that's one of our Quattro pillars as well. It's funny how similar I think Holladay Ventures and Quattro Capital are. We have different product lines, different missions, but that's exactly it. Finding a way to really, take care of those who need a helping hand, not a handout, but a hand up, right?
Yep.
So that is all fantastic. What you mentioned that you got involved with this, top of the market developer or top of the line developer, affordable housing developer in the country. What time frame was this when y'all were trying to put people back to work with? Sorry, before that, you were trying to put people back to work with your modular housing. What time frame was that? Was that the last? That was crash?
That was 2011 to 13. Okay, kind of my sophomore through senior year of college.
Great.
And then outside of
jobs.
Yeah. Honestly, we're fortunate that it was kind of the upswing. Action was happening. People were starting to invest again, but there was still that heartburn from the crash. So the places where we're trying to give jobs back, specifically houseboats, like nobody was buying houseboats in 08, 09, 2010. So they laid off 1,100 skilled workers who knew, how to create a $100,000 houseboat. But nobody was buying. So they had to lay off all these great workers. And so we were thinking about it. Well, how can we use literally the same exact shape? You take the same shape, it's a rectangular shape, and you put it on a foundation instead of put it on water. It wasn't our idea, but we found people who had that idea, and they'd already started the ball, building the momentum around building the plans. And we said, hey, could we commercialize that? Yeah. And they were just students and professors, and it was for a class for them. But we were like, hey, this has real commercial potential and real impact potential. And that's what got us excited about it. And it's amazing. It's like, you don't have to have the idea yourself. You just have to have the energy combined with that idea, even if it's somebody else's idea, building upon that and building that with momentum and action can create something really powerful.
I love, you said that a couple of times now, and you don't have to create to do good and do well in this world. People do that. You don't even have to innovate. You have to improve, right? So you can take something that works moderately well and improve upon it, and then make it apply to the need of today, which is exactly what you've done on multiple occasions, it looks like, and having the guts to, that you call it naively growing in an area, right? But having the guts to, as you're climbing a staircase, take a step, be willing to take the next step when you can't see the step that your foot's going to land on. It feels like you're going to land on thin air, and it materializes right before it needs to, right? And you keep doing that. That takes some guts. I love it. So as you have developed into Holladay Ventures, maybe tell the audience a little bit. I think people understand in general what multifamily development is. They understand what development is, and they may even understand what, being an impact developer is. But let's get into the nuts and bolts a little bit. What type of property do you develop? How do you do it? Are you sourcing capital the same way everyone else is? Are there tax credits involved? Like, let's get into those nuts and bolts a little bit, if you don't mind.
Yeah, let's dive in. So our typical deal, so we do a couple different types of deals, but I'll go into our typical structure. We do probably 80% of our deal flow is 200 plus units. And it is a public-private partnership where we partner with the state housing agency. And a lot of times we even partner with the city or county, like the local government. So we partner with the city, the state, and we're ultimately using a federal resource to help finance this. And so that's why it's the true public-private partnership. So we're taking I'll back up. Our product is workforce affordable housing. We like to call it attainable housing. It's something that's built at an attainable price point for our community and our residents.
Yeah.
It just has a better branding to it than affordable housing. So our attainable housing communities, we specialize in typically kind of that 60 to 80% of area median income. And so those are, those are families making, like in Nashville, for example, where you and I are, it's like 35 to 65,000 per year for a family income. Now, there are a vast majority of jobs here in Nashville that fit into that window. And yet those families are like constantly and ever growing. They're priced out of good quality housing within where their jobs are, within the communities where they currently live. They're being pushed out. So they're being pushed out 45 minutes, an hour out into like outlying counties, suburban or rural locations that are 45-minute plus commutes to their jobs. And so that puts a real stress on these families, or they're forced to live in housing where they're paying 50 to 60% of their monthly paycheck. So if you imagine you get two paychecks a month, more than one of them goes to pay your rent. And there's a lot of families that are on that currently, like that current situation. There was a study done. There's 7 million families that are paying more than 50% of their annual or their monthly paycheck on rent. And that was pre-pandemic. So I can only imagine that number has skyrocketed since then. And so there's a massive need for this across the country. It really boils down to a supply and demand problem where we're just not building enough housing. Mm-hmm. And there's too many bottlenecks around housing, whether it's financing, politics, zoning, permitting, construction cycle, whatever it is. Like there's a lot of bottlenecks, which causes a supply and demand problem, which causes us to basically, most developers are only building like top high-end luxury housing. So there's kind of this void in the marketplace, and cities are hurting because of it. So that's where cities and states have started to say, hey, we have a real problem. If we don't keep things at an attainable price point, then we're going to start losing out on growth. We're going to start losing out on our supporting economy, the backbone of our economy, the service, the retail,
service industry,
the workforce of our economy. Like those people, if they can't afford to live in a city, then the city will become unaffordable. And then it's less desirable to live there. It's less desirable to relocate jobs there. It just has this domino effect. So cities are going crazy right now. They're like, how do we figure out affordable housing? And so they look and seek out partners like us who know how to do development, who know how to do affordable housing. And so we work with state agencies. They provide us tax credits. And those tax credits typically cover about 40% of the cost of construction. And in return, we agree to maintain a lower rent level that is no more than 30% of a family's monthly paycheck. And it's in that 35 to 65,000 per year income range. And so we take those credits, they get awarded to our project by the state. Then we turn around and sell those credits. They're dollar for dollar write-off on taxes to investors or syndication groups or even banks. And so that funds roughly 40% of our project. Then we have a loan for about 50%. And then the last piece is the last 10% is usually like a tax abatement. So we'll get like a 10 to 20 year tax abatement from the local government, or we'll get grants, like local grants or state grants to help fill that. So it's kind of a really unique structure. It's nothing like anything you'll ever hear in real estate investing. Right. So our tax credit equity investors, they just want tax credits, losses, and depreciation. They only look at this as a way to offset their tax liability from other income that they're making outside of this business. And so they either take it themselves or they're a syndicator and they go off and they sell that to different banks. It's typically banks, insurance companies, or private equity because we're dealing with large, substantial amounts of credits, anywhere from 15 to 25 million in credits. So they don't want any cash flow. They don't want, so we don't ever look at.
They don't want more money. Right?
Yeah, they're trying to use this to offset taxes, and so they don't want cash flow. They don't want, there's no IRR, there's no cash on cash calculations. It's only really the main thing we're looking at, the main thing we're negotiating with our equity guys is what is the pricing they can give us per tax credit dollar. So right now the market's like 88 cents per dollar of tax credits. They will give us 88 cents in cash equity. And so we as the developer and the GP partner, we get the long-term cash flow and developer fee, and usually long-term ownership as well, because they only want the tax benefits. So once those expire after year 10, then they pretty much want out of the deal. So it's a really interesting model where it's a great way. It's probably one of the best examples of public-private partnerships, because we're using a public good and creating a public good, but using privately financed sources with syndicators and private developers like ourselves, and being able to create something that really creates impact for our residents. And so that's why we like to call what we do impact investing and impact real estate, because you're really having impact. It's recession resistant. You're dealing with something that we're basically building is almost as good as a brand new luxury community, but we're charging about half or 40% of the rent. And so you just have this inherent humongous demand, especially in growing cities like Nashville and Charlotte and Austin. Cities are just hurting. Nashville needs 31,000 units right now. Like we know all the affordable developers right now cannot build enough units for the demand. And so it provides great returns for our investors and great impact for the residents in the communities.
Truly a way where everyone wins, right? When you win, everyone wins in this.
Yeah.
That is amazing. And so that really probably pushes you to a certain avatar of investor, right? You're really looking for, I'm going to guess, probably high income, maybe not necessarily high net worth, but high income individuals who are trying to offset, whether it be W-2 income or some sort of business income. Is that the typical avatar? And do you source those investors directly, or do you kind of go to a pool somewhere where they're aggregated and they find you?
Yeah, good question. So we have two different types of investors. We have like our pre-development capital investors. That's basically from the point we know it's a go to the point we close, before we even move like one shovel full of dirt. That's like a 2 to 3 year process. Yeah. And so those pre-development investors, we typically raise 2 to 3 million per project. Those are paid out of the front end. It's almost like a hard money loan. And then
out of the developer fee, you might pay them or something like that, right?
Yeah, exactly.
Yeah.
And so, so that's the front end. Those are pre-development investors. And then on the back end of the deal at construction loan closing, those investors will be paid off and made whole. And then we'll have new investors come in. Those are tax credit equity investors. And those are not individuals. Those are typically private equity syndication groups or banks or insurance companies. It's basically, I wish we could work with individual investors, but the tax code changed. They originally allowed it. Tax credits were invented or made into the tax code in 86. I think it was in like 92 or 93. They made it so that individual investors who were not real estate investors couldn't really invest in these. And so it kind of killed the market for individual investors. And so we sell this to larger groups, and also banks are required to invest in these as part of their CRA Act, basically saying like banks can't redline, right? So federal government is trying to be intentional about this and say, hey, let's help, or let's require banks to invest in every part of a city, not just the higher income areas or the areas they want to invest in. And so they are actually required. So we have another built-in demand for our tax credit equity investors because they actually need to buy these credits in their markets.
Yeah. And that CRA credit, that's the Community Reinvestment Act, if I'm not translating that for the audience. So we've actually seen some of that money in a different form in like there's a CDFI lender, Community Direct Financial Institution, where they do a similar thing. Those banks give money to that CDFI lender and they redeploy into, the redevelopment projects that we would do,
exactly.
Or something like that. So that's really good to see that money all comes back around. And I guess the only people that are losing are the tax revenue services, but in essence, they're investing back in the community.
Right. Exactly.
That's really good. That's really good. And so you mentioned that it takes 2 or 3 years from inception to, I guess, lease up, maybe is the back end of that, to execute one of these projects. Does your team also stay on and operate the property, or do you then disposition the property to another group? How does that work?
Yeah. So we are long-term, we're build and hold developers. So we'll asset manage. We won't property manage. We'll work with whoever's the best, boots on the ground in that local region. But we will be long-term holders of our properties. And so we can, at the end of you have like a 15-year compliance period where you have to keep it affordable with the federal government. Usually states are adding on their own affordability period on top of that. And so we'll basically keep it through that period and then decide if we want to fix it up or just continue as is.
So to bring it into multifamily terminology, you basically build an affordable community while it's needed, operate it and keep it up for 15 years. You're kind of paid on the front end for that, I'm pretty sure. And then, and then tax credits eventually burn off. And then you just have sitting in your hand a nice value add asset that is probably ready for repurpose and it's now obsolete compared to some of the newer tax credit properties, right? So it's something you could probably renovate and bring back up to just conventional market rate or something. Yeah.
Right. And you can also do double tax credits on it. So you can basically at the end of year,
do it again.
Yeah. You can, it's called like resyndicating. So you can resyndicate the credits after year 15. Usually you really won't need to until about year 20 or so. But it gives you the opportunity to, like you said, update the property, extend the affordability period, and you get paid another developer fee through that method.
Do you do, and I think I saw you did one in Kentucky recently, but have you done on any of the redevelopment type projects as well, or only ground up at this point?
Yeah, so we've done a couple like value add type deals with an affordability component. We haven't done a resyndication where we actually like take it through with tax credits, but we have acquired existing affordable communities and basically fixed them up, brought them up to true market rents, but they were still within the affordable range of rents.
Gotcha. Very cool, man. This is a really interesting game. It's a different strategy that I think I've ever seen, but I love the community aspect of it. And you're right, it is so needed. I mean, as you watch, I looked at a Neil Bawa chart the other day, the numbers guy. As you watch home values increase across this country and AMI is really not going up near the rate, you're seeing people priced out of home ownership and into renting, and then further priced out of the markets where their jobs are and out, to where they're forced to commute long distances. So this is really a need in our country. I love that you're doing this. Well, Evan, let me ask a couple of questions of you real quick that we ask all of our guests here. So at Quattro Capital, we really like to know what your superpower is, because that is what drives each one of us to excel in our related areas. So what is your superpower as it relates to your business?
Yeah, that's a great question. I think really for me, it's getting above the clouds and figuring out what is the 1 to 3 things that's really going to push us in the right direction. We kind of think about development like you literally have to make, I don't know, 5,000 decisions, on a deal, probably at minimum.
Oh yeah.
But our job and like what you're doing in the value add spaces, our job is to figure out the 1 to 3 things, the dominoes, the biggest dominoes at the very front of the line.
Mhm.
They're going to knock down all the other dominoes, and being able to keep a really level head throughout. Because we also say in the development business that your deal dies 1,000 times. You just have to make sure it lives 1,001. So that's so true. Like the amount of times, like the deal we're working on now, it's $60 million development. We're going to close in a few months. I've been working on it for 2 years.
Yeah.
I think we're about 1.2 million into it by now.
Yeah.
And we're taking a lot of risk, and literally every month it's like something goes good, something goes bad, something goes good. It's like 2 steps forward, 1 step back, sometimes 5 steps back. But that's just, you have to keep that even keel, that level head throughout.
Yeah. Yeah. I'm laughing because I've felt that before in different ways. Of course,
Yeah.
I'm sure development and dealing with government is a lot beyond what we've had to deal with. But anyway, so Evan, what is your biggest failure to date and what did it teach you?
Biggest failure to date. I think really for me, it was not being 100% confident in myself at an earlier stage in my game. I think for me, when I was first starting out Holladay Ventures, you take that leap of faith as an entrepreneur and it's scary at first. And then you wonder, you're like, hey, can I really do this on my own? Can I go about this? We all have those fears that like those,
Yep.
that second voice in your head, that evil voice. And you just have to remind yourself that those are just like little monkeys on your back, and you just have to get them off and remind yourself, hey, I have done this before. Hey, I am fully confident in myself. I'm fully capable. I believe in myself. All my friends and family believe in myself. And so I think having that full belief in myself from the beginning is likely my biggest failure, but I think it's also one of my biggest learning lessons too. And it's helped me be even more confident in myself now.
I love that. And that's really that's the growth mindset mantra, right? And everyone struggles with this. We all have limiting beliefs coming in. I'm again laughing because I'm remembering mine. One thing we have to do as investors, as business owners, as doers of good in this world, you have to look back and see what you accomplished, right? Because if you look back at your 1-year-old self from today, you were a lot less good than you are now. And a year from now, you'll be twice as good as you are. It's a compounding effect. So I love that you said that. And we talked in the beginning about it, Evan, but you host one heck of a monumental podcast. Can you tell the team here where they can find that podcast?
I appreciate you, Chad. Yes. So Monumental Podcast, it is on evanholladay.com. That's probably the best place to find it. But we interview some amazing leaders that are making massive impact in the world and really, shining a positive light on the world and helping a lot of people. So it's a really fun podcast, and highly recommend everybody check it out. I appreciate you, Chad, for bringing that up.
Absolutely. Absolutely. And, at Quattro, we have 4 pillars or morals and ideals, whatever you want to call them. First it is people first, then it is property and profits. But you know what? Philanthropy is our biggest and most passionate one. Tell us what philanthropic causes you're involved in and perhaps how the audience can support if they feel so compelled.
Yeah. So probably one of the ones I've had the most fun with recently has been Bookem. They're a nonprofit based here in Nashville, and they actually donate quite a substantial amount of books to kids in need that can't afford books. And on top of that, they do reading events. So right before COVID, we actually, with our Phoenix Club group here in Nashville, which is a service group that I'm a part of. And we went and basically spent a whole morning with third graders and read multiple books to them. And then we're able to donate, hundreds of books to that school and all the kids there. So That's a really great group. I highly recommend them. They're doing amazing work.
Well, Evan, this has been a incredibly insightful episode on a topic that honestly we have not really discussed on the show at all. So thank you for coming on. Thank you for being willing to share your expertise, your history, and your heart, honestly. And if the audience were to want to reach out to you and get a hold of you, maybe to partner on something or invest or buy a tax credit, I don't know, how can they find you?
Yeah, definitely. I'm really active on Instagram. For everybody on here that's on Instagram, it's at Evan Holladay. Holladay's Holladay. That'd probably be the best place.
Fantastic. All right, everyone. Well, this has been another episode of the Real Estate Runway Podcast. Over and out.
We hope this episode was insightful and brought value to your day. If so, please be awesome and leave us a 5-star review. Find out how Team Quattro can help you at thequattroway.com. Until next time, this is the Real Estate Runway Podcast.